Click the bell icon to get latest videos from Ekeeda.
Hello friends, today we'll be doing one question of marginal costing covering all possible sub-question or elements of the topic. A company annually manufactures and sells 20,000 units of products, the selling price of which is rupees 50 and profit earned rupees 10 per unit. The analysis of cost of 20,000 units is material cost 3 lakhs. This material cost is variable cost. Labor cost 1 lakh. Labor cost 1 lakh is a variable cost. Overheads total they have given 4 lakhs, but they have said here 50% variable. That means 2 lakhs is fixed and balance 2 lakhs are variable. You are required to compute contribution per unit, PV ratio, break-even sales in rupees, break-even sales in units, sales required to earn profit of 4 lakhs, profit when sales is 18,000 units, margin of safety when actual sales is rupees 7 lakhs. Let us try to first understand how to prepare marginal cost statement. We have to first consider the amount of sales. Here they have said units sold is 20,000 and selling price they have given rupees 50. Thereby we can get the total amount of sales. Total amount of sales is 10 lakhs and per unit selling price is rupees 50. Material cost they have given here rupees 3 lakhs. Labor cost they have given rupees 1 lakh. Overheads 50% are variable. Out of 4 lakh, 2 lakhs are variable. This is what we got the total amounts. We can calculate per unit 3 lakh divided by 20,000 units. It comes to 15 rupees. 1 lakh divided by 20,000 units, 5 rupees. 2 lakh divided by 20,000 units, it will be 10 rupees. We can add all variable cost, total of these 3 items. So total of variable cost is 6 lakhs. Per unit total is 30. If we take sales as A, we can take this as B, that is total variable cost. From this 10 lakhs, we can deduct this variable cost 6 lakhs. A minus B, we can get contribution. 10 lakh minus 6 lakhs, it will be 4 lakhs. Similarly, per unit, 50 rupees minus 30 rupees. Per unit contribution is rupees 20. Overheads 50% variable and 50% fixed cost. So our fixed cost is 2 lakhs. From contribution, we'll deduct this fixed cost 2 lakhs. Thereby finally we got profit 2 lakhs. This fixed cost 2 lakh divided by 20,000, we get per unit fixed cost 10 rupees. 20 minus 10, finally profit also we got 10 rupees per unit. This information is given in the question. You can see here profit earned is 10 rupees. So this is the format of marginal cost statement where sales will be the first item from which we are required to deduct variable cost. Sales minus variable cost, we get contribution. From contribution we are required to minus fixed cost. Thereby finally we arrive at the figure of profit. We are required to find out contribution per unit. Contribution per unit we have already obtained here. Contribution per unit is 20. Contribution per unit is equal to sales minus variable cost. Selling price is rupees 50. Contribution we can get by deducting total variable cost per unit, that is 30 rupees. So here we got contribution per unit 20 rupees. Further they have asked us to calculate PV ratio, profit volume ratio. Formula for PV ratio is contribution upon sales multiplied by 100. We got sale 50 rupees per unit, contribution 20 rupees per unit. So we got profit volume ratio, PV ratio 40%. Next we are required to calculate break-even sales in rupees. Formula for break-even point sales in rupees is fixed cost divided by PVR. Fixed cost, here we have in the question rupees 2 lakhs divided by PVR. Just now we have calculated 40%. So break-even point sales in rupees is 5 lakhs. Next they ask break-even point sale in units. Formula is fixed cost divided by contribution per unit. Fixed cost 2 lakhs. Contribution per unit we have 20 rupees. 2 lakh divided by 20, it is 10,000 units. So we have got break-even sales in rupees, break-even sales in units. Now sales required to earn profit of rupees 4 lakhs. Fixed cost plus required profit divided by profit volume ratio. This is the formula we are required to use to find out required sales to earn particular amount of profit. Fixed cost rupees 2 lakhs. We need profit of 4 lakhs divided by PVR 40%. So it comes to 15 lakhs. So sales required 15 lakhs to make profit of 4 lakhs. Further they say profit when sales is 18,000 units. In this case we can calculate the total sales amount. Total sales amount 18,000 units sold for rupees 50. Amount comes to 9 lakh. We can find contribution is equal to sales multiplied by profit volume ratio. Sales we have 9 lakhs. Profit volume ratio we have calculated. PVR is 40%. So contribution is 3,60,000. Profit is equal to contribution minus fixed cost. Contribution here is 3,60,000. Fixed cost we have 2 lakhs. So profit 1,60,000. So we have calculated profit when sales are 18,000 units. Finally, margin of safety when actual sales is 7 lakh rupees. Margin of safety formula is actual sales minus break-even point sales. Actual sales they have given rupees 7 lakhs. Break-even point sales in rupees 5 lakhs. So actual sales 7 lakhs, break-even point sales 5 lakhs. 7 lakh minus 5 lakhs. Margin of safety will be rupees 2 lakhs. So this is how we can calculate various elements asked in question of marginal costing. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda.